Hi everyone, welcome to our channel where we help your real estate investments work harder for you. I'm Samantha from Elevate Realty in Toronto. If your goal is to make the highest and best use of your capital in real estate, what should you do? In this video, I'll be comparing 3 strategies based on a 10-year investment time frame. 1, buying and holding a property for 10 years. 2, taking profit of your property and buying a bigger property every 5 years. And 3, using refinance funds every 5 years to add an extra property to your portfolio. So, out of the 3 strategies, which one provides the best returns? Before I talk about each strategy in detail, remember to subscribe and hit the notification bell so you don't miss other real estate investing videos like this from our Elevate team. I'll walk through each strategy one by one, and if you wait till the end, I'll give a full financial breakdown and reveal the winning strategy. Strategy 1, buying and holding for 10 years, has the least amount of work and also the lowest transaction cost of the 3 options. Each time you buy and sell a property, you have to pay land transfer taxes, legal fees, and each time you sell a property, you need to pay agent fees and HST, and these things can almost add up to 10% of your purchase price. But there's 2 issues that limit your returns. As time goes on, your mortgage amount decreases and your rental income increases, so you'll get more cash flows, which is great. The problem here is that cash flows alone might not be enough for you to buy another property, so you can't get the same returns on this accumulated cash flow. Number 2, you build up equity and appreciation over time, and the problem here is that it's stuck in the property, so it's not invested efficiently. Now, another way to look at this is that as your equity increases over time relative to your mortgage, you lower your leverage, which means that you also lower your rate of return over time. For example, when you start your mortgage with a 20% down payment, you're 5 times leveraged. If annual returns are 7% on your property, you're essentially getting 7 times 5 or 35% returns on your capital in year 1. Closer to year 10, your loan is now only a third of your property's market price, and you own the remaining 2/3, so you're only 1.5 times leveraged. So with the same 7% annual returns times 1.5 times leverage, your returns are closer to 10.5% on your capital. Your risk has dropped significantly compared to what you started with, and so have your returns. And if I were to summarize the strategy, I would say that you get a higher retention of equity combined with declining rates of return over time. Strategy 2, taking profit and buying a new property every 5 years allows you to put your money to better use. When you buy a new property, you're essentially restructuring your equity so that you can improve your leverage and your returns. Now, there's also 2 issues with the strategy. Number 1, every time you sell a property, there's high cost relating to legal fees, selling fees, and HST. And number 2, when you sell a property, it also triggers capital gains tax with the government. And this also reduces the amount of equity you can put into the next property. I would say strategy 1 and 2 are opposites of each other, and it's really hard to tell which one is better if you don't crunch numbers, so I'll leave that to the very end. If I were to summarize strategy 2, I would say that it has a lower retention of equity combined with more stable rates of return. Strategy 3, refinancing and restructuring every 5 years, is kind of a hybrid of the 2 strategies. When you refinance, you can access and reinvest the equity in your existing property without triggering selling fees and capital gains tax. Somewhere down the road, when you decide to sell your investments, you're still responsible for these costs, but it's definitely deferred. The negative here is that refinancing means that you're borrowing money even though you have this money technically as equity. So your interest expense is higher than the other strategies. For the strategy, I would say that there's a higher retention of equity combined with stable rates of return, but you also have the highest costs. And finally, here's my favorite part, as always, the numbers. In my financial comparison, I use the same starting capital at $186,000, which includes a 20% down payment on an $800,000 house plus closing costs. I also assume 5% appreciation, 4.5% rental cap rate, and 2% mortgage in all of the properties. For strategy 1, buy and hold for 10 years, the total return including appreciation, cash flows, equity gain is $775,000. After you deduct selling costs, closing costs, and capital gains tax, you have a 10-year net return of $586,000. Now for strategy 2, taking profit and restructuring every 5 years. In years 1 to 5, your total return on your first property is $346,000. Then you sell your property and deduct selling costs, closing costs, and taxes, so you're left with a 5-year net return of $237,000. You take that plus your original capital to buy another property with 20% down payment. So your total return in years 6 to 10 for this new property is $706,000. And then you also deduct costs and taxes, which leaves you with $471,000. When we add up the returns of both properties, we have a total 10-year net return of $708,000, which is better than strategy 1. Strategy 3, refinance and restructure every 5 years. The return on the first property are exactly the same as strategy 1. So you have a 10-year net return of $586,000. Anything extra you make on the second property is bonus. So even without looking at the numbers, it's already better than strategy 1. At the end of year 5, you refinance the first property to take out $178,000. Assuming the same interest rate at 2% per year for the next 5 years, the total borrowing cost for this is $17,000. Now you use this money plus your accumulated cash flow to buy property 2. And the total return for years 6 to 10 on property 2 is $367,000. Then you take out costs and taxes, which gives you a net return of $242,000. Now, let's add everything up for this strategy, and your total 10-year net return for strategy 3 is $811,000 and our clear winner. If your goal is to put your money to highest and best use, then you'll want to preserve your equity as best as possible. You should also restructure your portfolio if there's significant changes so that you can maintain your leverage and rates of return. The benefits of refinancing is that you can defer the bulk of your costs to the very end since you aren't actually selling anything. So your returns will actually snowball a lot quicker with a bigger base. Refinancing rates are low compared to what you can get with real estate returns, so it's definitely something to consider if you want to maximize your real estate returns. When you're considering refinancing, you need to make sure you're not stretching yourself too thin and over-leveraging. Positive cash flows are key to having a sustainable, long-term real estate portfolio that can withstand fluctuations in the market. Our team specializes in real estate investments in Toronto, and we can help you review your portfolio and give you recommendations on how to put it to highest and best use. If you want to schedule a call with us, you can contact us by heading to the link I'll put in the description below. Finally, if you find this video useful, please remember to give us a thumbs up and help us out by sharing it on your social media and tag us at Elevate Realty CA. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video.